It is the 5th of September, NFP Friday actually, and I just wanted to talk over mostly just this trade. Pretty much traded a bit of gold this morning, then my main focus was NASDAQ. I was extremely confident in the short. This is just a practice account, but I did manage to catch the trade I was looking for on the practice. And then on the challenge that I'm doing currently, I actually took a short just in this area, which did play out as well. But it didn't play out, but it was profitable. So I want to go over what I was seeing, why I was so confident in the short. I want to go over the actual entry and why it was such a good trade. And then last of all, finally, I'll go over my personal executions and what I did right, what I did wrong. But the main focus is just to go over what actually works so good. So just to have a quick summary of this particular trade on the practice account. My entry was based off of this long wick midpoint. You can see that I sold 5 there and then immediately covered right after on this next candle and at the same price basically. And the reason for that is because I realized that we had just broken this low, we'd broken ERL, and so rather than shorting at that midpoint, I actually should have waited for us to retrace back above it and then close back below. So as soon as we close back below, that wick now becomes a valid entry point. I then sold on this candle as it rated this candle and also at the institutional level of the 50s. Then that worked its way down into my targets. So I'll go over to here. This is the chart that I usually watch while I'm trading. So you can see it's already got a whole bunch of annotations on it, which are making it a bit messy. But so I'll move over to a clean chart. But this is what my chart was looking like by the end of the session. And I will copy a few of these key lines over just so that I don't have to copy and paste them again. I might as well use that and that. So Control C, and I'll paste them there. Too easy. So I'll quickly show a bit of context of where we're actually at. This is the high time frame. It's showing signatures of weakness. We've actually got SMT on the highs. But at the same time, you can see that we're rejecting these lows. So we rejected the impulse low, got a nice reaction out of it. But we'd already come down here. So the fact we came back down is showing a lot of weakness. However, I recognize that since we have just been in a bull market, if we are going to start a high time frame retracement or reversal, we are likely to see this kind of more range-bound price action where we're taking both premiums and discounts. And because we've got the SMT on the highs, there is the possibility that the high is in, and it kind of reminds me of this area where everyone was really getting confused if it was bullish or bearish because we kept on making, looking very bearish down here, then looking very bullish up here, then bearish again, and then bullish again. So it was going to both the premiums and the discounts, and this often happens when a trend is ending, as you'll start seeing what PD arrays that should be holding for bullishness start breaking, but then it goes straight back the other way, and everyone who got shaken out down here, they now have FOMO, jump back in, and that often happens, and that kind of looks similar to this. So I was expecting we were likely to come up here to this previous week high, and I had also this old previous week high marked out. It's a very key liquidity level as well. We were actually opening after NFP, we'd already hit all these levels, so that's just to give a bit of an idea where we were at. You can see if I zoom out a bit, all these lines just represent the different days, don't really need that. But you can see that we are opening up at 9:30, which is roughly here, all the way above these levels. The reason I have this midnight price marked out all the way here is a little nuance that I've noticed with midnight is if we fail to return to the midnight price during the regular trading hours, so on this day, opened at midnight, traded lower, this is RTH. We got kind of close, but not, it's probably close enough, but in general, I prefer to see it get a bit closer, especially this is actually during 1800. So during the regular trading hours, which is actually, that's as close as we got to the midnight price, which is still a good 35 handles off. So I find that when that happens, it means that all the price action following that I see as being at a discount, and it can sometimes go on for a few weeks as it did here. But that was just another little confluence of why we are likely to reach here, and then also upon reaching here, this could be a higher time frame swing points that could form. But that's not as important. I'll delete that for now. Then the previous week high and the old previous week high as well. They're both key levels. So we were running above that at NFP, and we're opening at 930, already above all these major buy side levels. So the model I was looking for today was simply the RTH trailed stop model, which essentially if we have a gap up, so on this day we closed at the regular trading hours over here, and we opened at 930 up here. So we have a gap up. I'm looking for us to engineer a low, entice longs like that, and then attack that low. And that's the trade, is to short attacking that low, then obviously any other targets that are further down. One more line I forgot to grab is this one, the regular trading hour close. And if I go to RTH, you'll be able to see what that looks like. So regular trading hour closes here, and then we open at 930 all the way up here. So a really big gap up, gapping above a whole bunch of buy sides. And that is the initial premise for the framework, is just looking for a gap up or gap down. Now, additional to that, you also want to look at our relationship to the midnight price. Midnight is all the way down here, so we are at a premium above midnight. So that is another check off the list to make it more high probability. And then on top of that, we have 830 sitting, I believe, right there. So we'll mark that as 830. 830, we're also above that. So once again, at a premium. The next thing I look at for the RTH trailed stop model is what was the RTH narrative going into the close. So if we scroll back and we look at the previous day's price action, that's our 930 open, we consolidate, take the lows out, and then all day we're just climbing higher all day, not really taking out much sell side at all, just continuously pushing. And then going into the close at 1550, we have this big nice rally that would have made a very nice target for this morning as well, which easily hit the 1550 low. But yeah, the narrative going into the close was that we were rallying and enticing long. So the last thing that, if you imagine a trader that doesn't know anything, doesn't know that ETH exists, they're living in the matrix, and in their matrix, RTH is the only thing that exists. They just see a big green rally into the close. All of a sudden we open all the way up here, and if maybe they had to put in an order at the close saying, okay, I want to buy on market open because it's so strong on this day. So big gap up, everyone's tripped in long. We know that anyone who was buying throughout the day yesterday, they need somewhere to trail their stops. And that is a very strong confluence for this particular framework that I have. The next thing I look at is, on top of the RTH narrative, which was that we were rallying into the close, enticing longs, I look at the ETH narrative. So if I mark out, I should have this lovely indicator. This simply colors candles whatever color I want, and I like coloring the 930 candle yellow. So that's the 930 open, and you can see ahead of the open we had NFP here, which took out a few lows and then ripped straight up. So at 1 minute after NFP, we're rallying higher. Now, anyone who wants to chase the NFP and wants to, if the NFP is showing strength and they want to buy, they see this big rally and they think, cool, this is a great place to buy. And then it starts working for them. So that's exactly what I want to see. I want to see anyone who is opposing my trade being enticed long, and also us not taking them out yet. So anyone who is long, they need somewhere for their stops. There's a lovely low right here for people to put their trailed stops. A few smooth lows there as well, and also here. So all those narratives along with the RTH narrative, made the short idea extremely good. Next up, we also are at the 900s. I mentioned before that I see these as institutional levels where we go to engineer liquidity and also to accumulate liquidity. Now, when there is no pre-existing liquidity at a certain price, such as the 900s, if you look to the left side of the chart, there is nothing there. Like, even if you go all the way over to this area, we don't have any highs that have been engineered specifically at that level. When we haven't already got engineered liquidity at an institutional level to attack, then a lot of the time we can actually go there, and then it does work as support and resistance. So the fact that we bumped into that high and then rejected it, that is also confidence that that high may remain intact. One more thing. My attention went straight to all these impulse lows. They, I find, have the ability to reject price really hard, and also the ability, if they don't reject price, to send us lower. So I was paying attention to these lows as we dropped throughout this range, and noticed that we were pushing down below these lows. But as you can see, we hadn't enticed any longs yet. My model is that I want to see us first engineer a low, and then entice longs, and then we can attack that low afterwards. At this point, we had engineered a swing low, but then we just kept on ticking lower. Eventually, we do exactly what I was looking for. We create this swing low at 938, 939, and then we start climbing up and get this nice big rally into the range. Now, within this range, I'm looking at all the internal highs, a lot of smooth highs, and I want to see, are there any really obvious highs that stand out, such as this impulse high. So that's an impulse high that I had drawn out. I thought, okay, well, what I want to see is if we can reject that high. I can see that we're clearly enticing longs. Can we reject this high? At the same time, I'm watching the 5 minute and the 15, and if we zoom into the 15, you can see this really long wick from 9:30 a.m. to 9:45. That gives me the narrative that anyone who is long, they see this as a bullish rejection. And so the fact that it rips straight back up and leaves this long wick gives me more confidence to fade that. If I drop down to the 5 minutes as well, you can see this similar kind of narrative where into the close of that 15-minute candle, we have this big bullish closing up close candle. That also looks like strength to anyone who was looking for longs. And so that gives me a clear indication of enticement. So at this point, I have everything I need to look for my short entry. What I figured I'd do is use the impulse rejection as my entry model, which is essentially look for an impulse high. I want to see us reject it. Now, usually when I do an impulse rejection for an entry, I want to see an impulse rejection failure on the lower time frame to actually get the entry. And what that looks like, if I draw a little diagram to the side, if this is our impulse high, and I want to see us reject it, that means I want to see us work above it and then not close back above. So if we work above it here, and then this is essentially what the low time frame looks like here, but the impulse rejection failure is then if we have an impulse low, such as this one, and then we begin to reject it, but then we fail to reject it and close back below, then that becomes the entry. So that's what I was looking for and I should have waited for. However, when I saw the second wick above there, I actually jumped in short right there, which was a bit premature. As you can see, it did still go in my direction initially, but that was the first thing that I didn't quite get right. And I'll zoom into the 15 second to show that. I'll do that real quick, but I do remember that I wanted to go over the actual trade and what made it so good first before I talk about my execution's two details. But I suppose while we're here, I might as well just go in order of what I actually executed. So I'll talk through this trade and then I'll jump on to this actual short that's worked out really nicely and a few really sick nuances about it. If we go to the 15 seconds chart, so I watch this while I'm trading as well, and we zoom into this area. That's that impulse high. We raid it once. We don't have any shift here, but we do create another swing low. We then run that high again and then break down. So at this point, we have this swing low that we have put in that made the high. I'm expecting this to stay intact because that would indicate that we have the impulse rejection that I'm looking for my entry. We make relatively equal lows down here. I don't think we took that. Oh, we did. We took that out by 1 tick. So that's not ideal. But then run back up, and I'd already got short just down here, which was the premature entry. But then we rally up. I'm kind of feeling a little uncomfortable because I realize I shouldn't have really done that. And then it begins dropping lower right here. But I am aware of this model of the impulse rejection failure that I'm looking for, which is the close below that low. And so I have my finger on the trigger to add to the position. So at this point, my stop's just sitting up here arbitrarily. And as soon as we get this closure down here, I recognize this is 9:45, and also that we had that as an entry. So I jumped in short right there, which was the perfect entry to have. That was exactly where I should have gone short to start with. And yeah, and then it tanks straight away really nicely. So this was a good trade. I had everything that I needed for it, including a entry on this model. My stop loss goes above that high, and we got the immediate reaction I was looking for. Now, following this immediate reaction, usually you'd want to see a fair value gap left. You do not want to see us fail to leave a gap and immediately reject straight back up. And if we do that, the very next candle needs to push lower. So you can see here that this candle worked all the way back up. So that's the first thing that's not ideal at all. So I was feeling a bit sketched out by that, just simply because I would have expected a breakaway gap. We then trade a bit lower. I take a partial down here because of that to rebalance back up, and that it was just not showing me that speed lower that I wanted. It was hovering around this level too long. It was making it too obvious. There was also this impulse low down here. I was very confident we were very likely to take that out because whoever had been buying, chasing this long, that's where the stop would reside. But as you can see, we actually didn't quite take it. But I thought there's a good chance we should hit this low. But it wasn't showing me quite what I wanted. So as it's lost its momentum in here, it took a partial. It rallied back up and worked out this high again. As it worked out this high, I figured, well, I took a partial down here, might as well add something back on up here. Added it back on, and then it drops lower. And then I was monitoring this very carefully because I realized actually it's looking lower and lower probability. I should not have added here because the trade is not, you only add to a trade if the trade is looking like if it's proving itself. At this point, it was looking more dodgy and I was just scalping this little range. So I shouldn't have added there, but in any case, I did a good job by monitoring it as it traded lower and monitoring as we hit these short-term lows. And as soon as I saw us start rejecting, I closed out the majority of the position, decided that I might as well leave a little bit on just in case, with a stop loss at the highs, and that got taken out. So another reason why this initial entry was good, so this was a good trade. It was just, it ended up coming back up, and I did a good job at recognizing that it wasn't showing me the weak order flow that I needed to see for it to continue pushing lower. And so I was more aggressive with my risk management because of that. And so I did a good job in that sense. Another thing that made this a really good trade was the fact that this is the 9:45 a.m. candle. Something I've noticed recently is that the 45-minute candle and also the 45-second candle seems to be the most likely to have a really strong melt of a move. So this could have easily been 9:45 open and just melted lower all day. And so when I saw us get that initial drop, I knew that it was 9.45. I knew that this was the entry model I wanted to see. And so that was a really good entry. So I'm happy with that trade. And this was on my, in fact, I'm logged into it even. This was on my challenge account on Tradeovate with, who are they? My Funded Futures. 278 today. I want to see if I can show the executions of that. So yeah, I had been wanting to not to micromanage my trades, not to over execute. However, on this particular day, I did take quite a few executions, and that is, I mean, it's reasonable because of what I just mentioned about it not showing me what I needed to see. But ideally, one of my goals for this week was to have a single entry and then 3 take profits maximum. I'll talk about this one as well. But as you can see, I had that initial entry there and then added to the position as we got that closure right there. So really good add. And then as soon as it sold off, I started getting near this low. I took some off because I had this happened really fast, and I just put on double the position that I just had. So I also trade on Tradeovate, not on TradingView, because TradingView, it glitches out really bad and it's really slow with execution. But Tradeovate's also a bit dodgy because you have to manage every single bracket order individually, and so I'm dragging stops around, trying to drag take profits. It was quite messy to do. So close out a bunch at the lows. It rallies up. I didn't like that, so I took the partial of 2 as we drop back down, and then I was holding, but when it works below that low and then started running back up, that's where I took that one off. And then to reward myself for taking it off at the lows, I decided to jump back in at the highs, which is what I shouldn't have done, but in this particular instance it worked out. It then drops down to lows, it rejects from down here and rips straight back up, and so that's where I closed out a little bit more. And then I brought this one down to break even from my entry there. So I brought this one down to break even. They got stopped out. And then the final 2, I thought, well, I'll at least leave a little bit on just in case, and that got stopped out up there. So overall, this execution, I think I'm pretty happy with it overall. It was the correct entry, at least this one was. And I recognized that it was not showing me what I needed to see. And the most important thing is that I did not take any more trades after it, not a single trade. So on this challenge account, so I'm really happy with that because that's one of my main goals for this week. I did allow myself this as a second trade on top of this, and that's because I realized that this was actually not a very good. I didn't have all the criteria just yet, and so I closed at break even with this particular trade. The reason I took it is, one, I was ultra bearish, and we already had some SMT on the highs, which we can see here. So that's 930, 931. ES had made a high, but it wasn't particularly significant. And then the thing that made me push the trigger was watching these wicks form, and you can see this wick here. So as I move to the next wick over, you can see that that's the new candle opening, and then this is that candle closing. So you can see that the majority of this wick, this long 1 minute wick, formed in the final 15 seconds of that candle. That makes that wick more likely to push lower than to run straight back up. And so when I saw that, okay, it's showing me bearish order flow, we did just run out this previous 1 minute candle high, as you can see right there. And the wick forms majority of it in the final 15 seconds. So the very next candle, I sold right in the open of that candle. It then starts running back up, and then as soon as it starts going against me, remember this would be a big, in my case, blue candle, I start second guessing it, and that's because it wasn't the intro I should have taken. We had not engineered a low and enticed longs away from it yet. That's what we did over here. So by getting in short there, it was a bit premature. We then drop a bit lower, and at this point I'm thinking, okay, should I just go break even? Yeah, probably should. And so basically close the trade at break even there. So I did a good job at getting straight out of the trade when I saw that it wasn't quite what I was after. Now finally, onto the actual trade. So what ended up happening? Why did it become a great trade eventually? Well, if we look over here again, you can see, so remember this was a long 15-minute wick that gives the narrative that we're enticing longs. We then had the big 5-minute up close, so that's great. But then the next candle, as you can see, 9:45, it drops down here. I wanted to see that continue lower. It didn't. It just consolidated down here and runs back up. When this candle closes, this 5-minute closes with another very long wick. So once again, enticing longs. When that closes with a long wick, this whole time, if we look at ES, it's just hovering below that 9:30 AM high. So that's that 9:30 high. And you can see we're just hovering below it, just digging up really close to it. And then at 9:45, it drops away along with NASDAQ. But then we have the SMT and the lows, and it still looks like almost that high. And then it starts running up to it. Finally, it does hit it at 9:49, just as NASDAQ is taking out to this high. That gives us SMT on the highs. So we've got some SMT right here. And as we get to that SMT, the very next candle, ES starts dropping lower. So now we have 9:50 AM dropping aggressively lower, and then it absolutely tanks. And at the same time, so this becomes a big 5-minute up closing candle, which is further enticing longs, and then the new 5-minute candle dumps. But when that's happening, NASDAQ makes a higher high. So at 9:51, 9:51, NASDAQ makes now a higher high. This is something that nobody talks about at all. ICT doesn't know about it. He's never taught it, and that's just a fact. But when we are entering a stage of distribution, the SMT will actually be inverted. So we have the relative weakness on NASDAQ here and relative strength on ES, with ES making the higher high. And then on the lower time frame, we then have NASDAQ make the higher high and ES make a lower high. That is a signature that I found gives the strongest SMT and gives the most epic moves. And when that is followed by this immediately displacement lower, you can trust that, okay, this is actually going to really play out. So that's the first thing that really stands out to me right here. The next thing is the fact, so another little nuance is the midpoint of this wick. If we draw that out, you can see we actually close above it here. Now, usually I'd see this as a manipulation closure because we got that immediate rejection lower straight after. So normally you'd expect that would be a bullish signature to close above, but when that's followed by an immediate rejection, that's what I call a manipulation closure. That often indicates a longer term swing point. I wasn't as confident in this one simply because we'd already run this high here. And so now this becomes a higher time frame wick from, like, I don't know what time frame. So it's in a time frame, there's going to be a wick in here where, like, it might be referencing the midpoint between the high and, let's say, this candle's high. Like, it might be referencing that. So that's why I wasn't as confident with it, but that could also be a signature to use as well. And then you see this 5-minute candle. So we have this really long wick. We then run down and we take out that low and we reject higher. So that is a very bullish sign. That's the fact that we took out this low and then rejected straight back up. That normally would indicate that we had just rated this low and this was a rejection. So what I want to see is, do we fail to hold this. If this happens, you do not want to see this wick run out, because this becomes an intermediate term low that took out this low and this long wick. You'd want to see this just rip up from here if you were bullish. So when we do that, I'm then looking for us to roll over again on this next candle. So I was wanting to see us roll down once again, but I was aware that we had just wicks below this low. Now, as far as PD arrays go to get in, as I mentioned, I was super bearish. Everything was looking good so far, so I wasn't worried about this wick rejecting us back up. I was expecting it to fail, but I wanted to get in. So what I did was I grabbed this wick, I grabbed the midpoint of it, and what I wanted to see is, well, I wanted to just use that as my entry, and that's using top set, as you can see, getting short at right there. My issue, what I did wrong there is that we had actually just broken this low, meaning we had just hit ERL, so external range liquidity, from this high to this low. We just hit external, which means we can go from external to internal, so premium internal from this high down to this low, the midpoint of the range. We can retrace to that before respecting this as a premium array. So normally what I want to see, let's say if I draw another diagram, let's say we have a wick, so this is our long wick, so that represents this wick here, and I'm bearish, I want to get short below it. If we break the low, and let's say the dealing range is from here down to here, and so that becomes our dealing range, and price is moving like this, and I want to see price get below, come up and hit it, and then send us lower. So that's great. But let's say price first comes down and then it hits a low, let's say that's external. That means that now, rather than it respecting this level, it can go above it and disrespect it to wherever it wants, and then only once it gets a close back below this level, then I'd expect that level to once again send us lower. That's what I failed to think about right here. Because as you can see, we retraced back up to a premium of this range, and then as soon as this candle closes back below this level, then, and we don't break external again, then it becomes a valid entry. But so that was why that entry was premature, but once again did a really good job by mitigating at 56 even. So I jumped out right there. On its way down, to be fair, so maybe it shouldn't have, but where is it? Yeah, but I mitigated. So once we had broken this low, at this point, this was the moment right there, that is the moment that it becomes, everything is perfectly in alignment. This becomes ultra high probability, and the reasons being is because, one, as I already mentioned, we'd already run out this long wick. We'd already rated that wick with this candle. So what I mean is this candle here had already taken out this candle's low. So we'd already rejected that long wick back up. If we're bullish, this should not have come back down. It then breaks that low again. So now it's showing that we've been enticing longs with these long wicks. So printing all these long wicks are further looking like a bullish rejection to anyone who's bullish. And then on top of that, if I look back up into this range, I look at, okay, well, should we come back up here? And the answer is no, because one, we have this as a large up-closing candle that has a premium of the range and respected the midpoint of this wick. But also, and most importantly, if you look at this old swing high to the left side of, so from this high, it runs up and breaks this high. You look at the high that it just placed through, and this is essentially an inversion fair value gap, but it looks a bit different. You look at that, and that becomes a old high that we displaced through on the way to hitting external. The fact that we ran up and we hit that high and rejected back lower, that's showing weak and bearish order flow. Also, we have, this would have been a bullish order block from that open down to the low. That did not hold at all. As well as the facts would also overlap this. So this is showing me that this high should not be taken out, and we shouldn't even come back up to this old high as well, especially with this nice strong displacement lower. So now I'm looking at, okay, where's a good place to get in? I'm just going to steal these two things, and also might as well grab that if I don't already have it. I do have it. So what these lines are simply representing the institutional levels of the 20s, 50s, 80s, and then hundreds is just there, and then 20s again, etc. Now, if I'm going short, ideally I want to accumulate above one of these levels. So you can see the 50 lines up nicely with that fair value gap. So I had my order sitting just above that candle. It got tapped in right there, begins trading lower, and then it runs up once more to take out that high once again, and then gets this beautiful drop lower right at 10 a.m. Testing the lows. So once again back to the executions, you can see getting short at 49.75, so one tick below that level, and then holding through this as it pulls back and then drops lower. Now I took off 2 down here because I had 8 on. I knew that there was a very high probability target down here, so potentially I could have held as well, but I also recognized that this so far had been really choppy and consolidating a lot, and I didn't want to be, like, at this point it's not really clear, like right here, if you think about what you'd be thinking right here, well, sure, it's probably going to go down here, but at this point it's consolidating a whole bunch, so what if it wants to just tap this low and run straight back up? So in order to mitigate that as a possibility and, you know, have this be a break even or losing trade because of it, I thought, well, I'll take off 1/4, 25% of my position at these lows. It's also beautifully at the 20s, so close at 20.52 of them. Continue to hold through here, and then as price runs up, this also becomes, as you can see here, enticement from false low into the M5. So we consolidate, create a false low, have a really large up closing candle right at 10:04, just ahead of a new 5-minute candle open. They created a really long wick and enticed longs, and then 10:05 drops directly lower. So that gave me a lot of confidence that I could trail my stop loss from here down to this high and even a bit lower if I wanted. So that became really nice. As we pushed lower, I took a partial down at just below these lows. So this partial I took was 94.75, which is actually right there, just a few ticks above. Then consolidates a bit sideways, drops lower. Now this is a really cool nuance, and I could have shorted here with a stop loss above this high, and I'm going to talk through that. That's potentially my new model, new entry technique I want to use. But in this trade, I was just holding, trailing my stop. But once we got the signature, I was able to trail my stop down to here. So in the meantime, actually, I trailed my stop to this swing high after we made this failure swing right here. This might be hard to see, but you can see that as we're trading lower, on the 15-second, you can see a bit more detail, but we create a failure swing just there that takes out this high, and then trade lower. If we trade back up, I would allow for us to tap that high and then reject lower. However, if we took out that high and then also took out this swing high, that would be very bad for the short. So trail my stop to there, but gave it permission to come up there if it needed to. It trades lower, we put in an intermediate term high and get a last second wick sell off. I take a partial down at the 50s, so once again using those institutional levels, that's the 50s right there. I use them as targets as well, and usually I go just a few points above, so 53 even. Took a partial right there as we dropped into it because we're nearing a deep discount of this range, and then the final take profit was just, I was aiming for the 700s, which was basically, that's essentially the RTH close right there, 700. And actually the high of day on the RTH chart was at 697.75, so that became a really nice target as well to reach for. Now I want to talk about this area. So if I drag this down and we look for it, where is it? Here. So I was mentioning earlier the concept of the last second wick, and that's pretty much what it is. As I mentioned earlier, I usually look for these long wicks as things to target. So long wick, I know that everyone wants to buy because of it, and so I want to sell and attack their stops. But that isn't always the case. Sometimes we do get an actual real rejection with a long wick. How I differentiate them is based on how much time into the candle that wick formed. So in this case, the wick actually forms right at the end of the candle. So as I'm watching this, I know that we're likely to accelerate into this low. We've already trapped longs above this low. So in this consolidation, everyone's buying, they're putting their stop below this low. They're now underwater. If they didn't put their stop here, or if they dragged it, so they've dragged it down to here. The price isn't going to let them out at break even. So I'm expecting us to continue pushing lower and accelerating into this low, especially on NFP. Now, so in this area, I'm expecting us to be bearish. I really like how we're leaving these long wicks to the downside and then overlapping them. That's telling me that anyone who wants to buy, they're getting tricked into buying here, and then we're dropping below them. But then I'm watching this area. We then run up in this candle, create a long wick, and in the very next candle right here, we open. So that becomes this candle here. So this is our opening of our new 1 minute candle, is that. Oh, I see, that's MNQ. Just jump over to NASDAQ. Where are we? Here we go. Okay, so that is our opening of our new candle. You can see that drawn out in the 1 minute as well. And when I look at that, I look at the previous candle. This represents the final 15 seconds of this long wick. As you can see, that final 15 seconds created the entirety of that wick, which is a relatively long wick. That indicates that there's a good chance this is an actual rejection. And why would it reject from here? Well, we just ran out this buy side. So we just hit some buy side. So we hit a short-term high, we rated it, and we are rejecting it. That rejection confirmed by the facts that we, 1, rejected, and 2, that rejection occurred in the final 15 seconds of this candle. So as soon as that happened, we start trading lower. And right at this moment, as you can see with the notes I had on here, I was watching it and I was thinking, I could add here. I'm not going to, because although this is just a practice account, a blown combine, it's just a practice account, I still want to try and execute trades how I would on my actual account. And I wouldn't just be randomly adding when I decided only to take one trade. So I didn't take it, but could have added right there, which was, they gave me plenty of time to add, and the risk would be above that wick. So I'm trusting that this was an actual rejection, meaning that my stop loss can go at the high of that wick. Now, is there enough range of opportunity? Well, if we put in a risk reward tool, let's say I got in at after the next 15-second closure. So here, I put my stop loss at that wick high. And let's say we look for 2R. 2R is right there. So that's very reasonable to reach for that. If we are going to push for this low, that's very reasonable. What's more likely is that we'll reach down to the 20s, which is just a bit below, so that becomes an easy 2.5R. And then even more probability is the 700s down here, which I mentioned was a very likely target. So 700s, that already gives you 3.6R just down to that. And then if you hold, then, it becomes a casual 10R or so. So this is a leverage opportunity where if you want to make money trading, you need to be taking high leverage trades. You need to have precision in your entries. You can't just be going, okay, well, I think it's a short today. I'm going to short in this range, give myself, you know, a decent stop loss, and let's see if I'm right today. And today you're right, you make 1.5 or 2R, you're like, cool. And then the next day you take a loss, etc. Like, maybe you can be profitable doing that, but you're never going to make it to money. If you want to make a shit ton of money, in my personal opinion, which I'm going to be doing soon, is you need to have precision in your entries. Futures gives you the ability to be incredibly precise. Like, you can be to the tick precision. If you want to get in at 55.5, or 55, let's say, but you can do that. You could get a fill there, especially with these prop firm accounts, because they're, you know, not in the actual live market. But even then, like, if I wanted to get a fill at precisely 90 because I knew there should be enough liquidity up there for my order, then I could get a fill right there and put a stop wherever I want. And if I was confident this high wouldn't get taken out, you know, you can get really tight entries, and so take advantage of that. But obviously you need a very specific entry pattern and entry technique for that, and this is one of them, where you have a really long wick, and normally I'd expect that we're probably just going to run out that wick straight away. We're probably going to, you know, we're just enticing shorts and then we're going to take them out again. But if that wick occurs in a manner like this, then that can be an entry to trust that we should melt lower. And obviously that's just an entry technique. You need frameworks on top of that, and narrative. So there are 3 things that I do, that I look at. Like, how I come up with a trade is I have, firstly, I look for a framework, and then after that, I'm looking for the bias and / narrative, and then the final step is to look for the entry. So these are the 3 components that make up my trade. And then in addition to that, I have signatures and price, and these are more things like the long wicks, the manipulation closures, just various signatures that tell me, help me with the timing aspect and tell me if I'm on side. The framework is the model I have here, which is that I'm using the RTH trailed stops with a gap up. So framework, I'll do it on this side actually. Gap up, I want to see us engineer a low, entice longs, and then attack that. So that's my framework. We have a, let's see if I can actually draw out a nice diagram, eh? So gap up, I want to see us engineer a low, entice longs, and then attack the low. So that is the framework. So the bias and narrative, that becomes into, okay, what is the high time frame telling me? Well, the high time frame is telling me that we are bullish on the high time frame, let's say. So if this is the high time frame I'm drawing now, we are currently bullish. We have some smooth lows down there, and this is how the day closed the previous day. So my high time frame bias is that we are bullish, but we're probably going to come down, take out these lows, and then go higher. So that tells me that a short is likely on this day. And then the narrative can also be on the lower time frame, that going into the close, we were rallying like this, and we closed the regular trading hours up like this. So RTH close. So that would be, if I actually separate these, so this will be bias, and I can say daily relative equal lows, and we are let's get this sorted out. There we go, narrative. So narrative can be that this was going into the close, and then similar to today, the narrative can also be that during the ETH, we were enticing people long ahead of the open. So that's also narrative. So once I have these two things, I have all that I need to take a trade. I know I have a framework, so I know I have an expectation on price and also a pattern in price. So this is basically a price pattern. You can see it happening here. So a framework is an actual pattern that you can see in price and an expectation on one outcome being higher likelihood than another. Bias tells me how does that fit in with the higher time frame and what I'm expecting to happen there. And although I'm bullish higher time frame in this particular hypothetical example, it makes sense for us to come down, take out these lows, and I can see how this bias fits in with my framework. So the bias and framework, they need to be logical together. If this did not make sense, if the bias suggested that there was, it would be really silly to look for shorts, then maybe you'd think differently. But then it can fit in either way. Like if this was bullish high time frame, and I'm thinking, okay, this framework makes sense because we could be going down to these relative equal lows. Or if we're just taking out relative equal lows, this could still just be a lower time frame due to slower, so an opposing price swing lower before moving in the actual direction. And then narrative so these are the two essential components, and then the narrative as well is the other part of the essential components. And that's telling me how does this fit into the narrative of what everyone else is thinking. I need opposing liquidity for me to take a trade. The only reason why price moves is to allow large institutions to fulfill their massive orders, and they need opposing liquidity. So I need to know that there is enough counter liquidity to take the other side of my trade. And another way of looking at it is I need to be able to identify orders in the marketplace, such as this sell side down here, these sell orders at a low price. I know that there are willing and unwilling sellers at a low price down here. And if we're opening up here, I need to provide that service to them. I need to provide them liquidity by buying from them at this low price because they want to sell down here. So that fits in with why I should be selling up here so that I can provide that buy side liquidity to these sellers at this low price. So once I have all these together, it comes to entry technique. The entry technique is how am I actually going to get into the trade. So let's say we're in this area. If I just copy paste this real quick. Copy. So that's where we're at. And now I need an entry technique. Well, that can be anything. Just for a basic example, I'll say, well, there's a fair value gap here. So that could be my entry technique. I'm waiting for price to come back up into here. Then I'm selling and we're going lower. So entry technique isn't a framework. Entry technique might have a lower time frame framework and narrative and bias to it. But entry techniques need to be used in conjunction with a higher time frame framework and bias and narrative, and that would become, the trade. So we have our framework. I have an expectation of a certain pattern and price playing out with a probabilistic outcome. We then have the bias and narrative, how this framework fits in with the high time frame bias and narrative, and also how the narratives in price on any time frame also make this a high probability trade because there's going to be opposing liquidity. That's the main thing. And then finally, once I have those things, I jump to entry technique, which is finding the entry. So going back over to here, you can see exactly that's what I did today. I had my framework, which was the RTH trail stops, which is the gap up. I then have my bias, which we're taking all this buy side, we have the sell side down here, and then narrative, we're enticing longs into the close on Thursday. We're also enticing longs ahead of the open in the pre-market. So that's a bunch of narrative. And also narrative can be things like these long wicks. That's also telling me the narrative. Then entry technique. In this particular instance, I used the impulse rejection to impulse rejection failure entry on the low time frame. And that was that entry right there. So everything was there for this entry. Everything, if I'd waited for this next entry, which I took, this is also fits the framework. This is another, just another entry model using the same framework and same narrative I already have in place. This entry down here, this can be within the same framework or a similar framework, but now at this point you have a different narrative, and I'll just classify this more as a momentum scalp, which requires more aggressive risk management, but it's another way of that I've come up with giving myself permission and confidence to take trades that most people will think that they've missed, that they're too late for. So if you're able to identify a pattern and you are able to identify if we're in a fast market or a slow market, so if we're in a very heavy one-directional market showing signatures such as this last second wick that shows heaviness, and you know where it's likely to accelerate into the low, then it's not chasing price to take a entry right there with a tight stop expecting speed. But yeah, that was a whole mouthful, but I think that was a pretty good explanation for how I come up with trades, and I feel like I did pretty good with it today, other than that premature entry that I took in this area. But this was a good entry for me, and I recognized that the trade wasn't working in my favor, so I'm really happy that I got out with 1R. I do want to adjust my trading so that it's not, if we look at this again, I don't want to be taking a million executions and having arrows everywhere. It's a little bit difficult with Trader8 because, as I mentioned, when I put on the trade with 5 contracts, it gives, with a bracket audits, I have 3 different take profits, 3 different stop losses, and then I enter even more position, and now I've got 6 take profits and 6 stop losses, and I have to drag them around individually, so it's not the ideal execution platform for me, unfortunately. But so I could have made this a bit cleaner, but ideally what I want is to be able to have, if I grab out some arrows, I want to have, okay, I sold here, cool, and then I have one exit wherever, like let's say there. So one exit there, and then I have one exit here, and then my runner, I exit down here. So that's what I want my trades to look like. One entry, 1, 2, 3 exits maximum, or maybe it might just be 2. One there, and then I exit the full position down here. But I don't want this. But I think in a situation where her trade is proven that it's not working, I think it's okay to get out of that trade early, and maybe, well, obviously it's okay to do that. But this entry here, that should not have been a thing, because as I mentioned, the whole reason I was closing this trade down here is because it wasn't looking that good. But other than that, I think I did quite well today, and overall for this week, I think I did pretty good. I traded 4 days this week, so that was my, I only had the account 4 days to be fair, but I wanted to trade 4 days this week. Let's see if I can bring up the stats. My funded futures, log in. Let's see, where are we? Is this the account? Okay, it hasn't updated for Friday just yet. This is Friday. But you can see that the first day, only one trade. Perfect. Day 2, one trade. Day 3, one trade. Exactly what I want to see. So really happy with that. Today is going to say 2 trades, unfortunately. That's just because that's premature entry that I took. See, I haven't actually looked at these stats before or used it. But yeah, so far, and I've been green 3 days. Now, I also wrote down in my goals that I expect to be green. I expect 3 out of 5 days to be green, and that's because I realized that having an expectation, if your expectation isn't met, that is not good. And if I'm expecting to, if I come into each day to trade, obviously I expect to win that day, because if I didn't expect to win, why would I trade? And that becomes an issue, because then if you don't win, then all of a sudden your expectation and your reality are different, and so you have stress, you're more likely to go on tilt and things like that. So what I figured out is, well, if I say that if I tell myself I expect to be green only 3 out of 5 days, that means that if I have a red day from taking one singular trade, it doesn't worry me in the slightest bit. And I think that's and that doesn't necessarily mean that if I'm red 3 days instead of green 3 days, that I'm suddenly going to go on tilt. But it means that after each individual day, I'm like, oh well, red day, that's fine, on to tomorrow. So that was one other thing I was doing this week. Another thing is the single entry and 3 profit targets. Did all right with that, although 2 days this week, as you can see, this day as well. This was also a break-even day where the similar situation today happened, where it just wasn't showing me what I needed to see, so I had to mitigate the trade. And then use percent chance that works. So earlier, what I was doing is every time I took a trade, I'd write out in one of these boxes, I have a 7.4 out of 10 conviction level. Now the problem with that is that if I have, let's say, for example, let's say for this trade I had a 7.4 out of 10 conviction level. Now if I have that, and then let's say the trade then goes straight to my stop loss, then that is a hit to my ego. All of a sudden, I'm like, well, I was really confident in this trade, and it just didn't work. And maybe I then find another trade, and on the next trade I have an 8 out of 10 conviction level, and then it goes straight to my stop loss again. All of a sudden, I have evidence in front of me that what I was confident in was completely incorrect. I have no idea what I'm doing, and I'm failing. And that's what the conviction level does. Now, if I change this from conviction level to 74% chance of working. So it's the same metric basically, but the difference between the 74% chance of working is that if it goes to my stop loss, then I'll be like, well, that was the 26% chance that it didn't work. What are the odds? Wow. And then if the next trade that I had an 8 out of 10 conviction level goes to the stop loss as well, then wow, there's only a 20% chance that happens. That's incredible that it happens. I'm going to, there's a 74% chance that would have worked though, so it was still a good trade. So it just makes it a little slight adjustment in my wording that makes it a lot easier to keep mentally in the right place. One last concept I'll go over. This is getting a long video, but this is a pretty cool concept. I'll do it on TradingView. So this is the action bias. So So action bias. What is the action bias? Well, the action bias is the tendency for people to favor taking action over inaction, even when there's no evidence to support that it leads to a better outcome. So if I write that out, tendency to take action over inaction. Yeah, and then there is a antithesis to this, or a opposite, and that's called the omission bias. The omission bias is, or it's essentially just the opposite of this. So if I change this around, make that inaction and this action. So the omission bias is the tendency to take inaction over action. Now this sounds like a contradiction. Like, how can you have a tendency to take an action over inaction, and tendency to take inaction over action? Well, it turns out that it depends on the motivation. So if the motivation for the action bias is that you want to gain the best of two outcomes. So that is, if that's your motivation, you want to gain the best outcome, then you are more likely to take an action over no action. If you think about, let's say you're in a trade and price is moving like this, and you want to, you're long and you want to target up here. You want the best outcome. You're moving towards the best outcome of making money. So you are moving towards gaining the best outcome. You are more likely to take an action in this scenario, even if by not doing anything, price could just keep on going up and go well past what you expected. But because you are looking for the best outcome, you're more likely to take an action. And what that can lead in is maybe you decide to take profit early. So that's the action bias. Now the omission bias, on the other hand, is when you are trying to avoid a certain outcome. So what that would look like in the same scenario is, let's say we have your long again, but in this case price has come down a bit and you're thinking, oh, it's looking a bit dodgy actually, I'm not too sure anymore. And so when you're in the negative, you're now thinking, okay, well, I'm either going to lose, if I make these red, I'm just trying to illustrate my point, or the point. So this is your option one, is to lose a little bit of money. And option two is to take a full stop out and lose a lot more money. Now, when you have omission bias, it's when you're trying to, so I'm trying to draw this diagram out, avoid a negative outcome. So you're trying to avoid a negative outcome, and when that's the case, you are more likely to have inaction over action. So you're more likely to do nothing. Now, the problem with that is that if you are actually wrong and price is looking dodgy, then it's more likely to go to your stop loss. So to put this a different way, if I get rid of these, both of these arrows, and I'll draw some new ones. So let's say the scenario is that it was actually a trade that was looking a bit dodgy. So the trades, there was your entry here, starts moving in your favor, and then it comes down a bit, and it starts looking like that, and it goes to your stop. Now, when this is the case, then you have the option throughout this trade. You might be thinking, oh, this is not looking that good, I'm not too sure anymore. But because you're already in the negative, you're more likely to do nothing and let it take your full stop. Whereas if we move this exact same scenario, even with the same thing over here, just trying to make this that fits nicely. Oh dear. Okay, so the exact same scenario, but when you're in, but let's say I was looking a bit dodgy and it ends up going up. So it looks just as sketchy the entire time. So in this area is the bit we're focusing on. We're just focusing on this square. So this square right here. So in this area in here, because you are in the negative, you're more likely to take to do nothing unless you take a full stop. And when it looks just as sketchy, but if price was, rather than down here, price was just slightly in the positive, you're more likely to take an action. So at this point, you might be feeling just as sketched out. Oh, it looks a little bit dodgy, I don't know anymore. Like the exact same patterns unfolding in price. But because you are in profit, you think, you know what, I wanted to gain the best of two outcomes, and price is currently, price is currently right here. Sure, if it goes to my profit targets, it'd be a lot better. But because price is here, I want to gain the best outcome. So I'm just going to close the trade early. And that would be what you're more likely to do in this situation. And then when it's just as sketchy looking, but you're in the negative, you're more likely not to take profit early. So although this would be the equivalent, closing here is the equivalent of closing right here. Because you are actually underwater, you're more likely just to not do anything and let it go to a full stop. And obviously that's a problem because it means that you are more likely to take full stops when you're wrong, and you are less likely to take a larger win when you're right. So how can we change this and use this to advantage? Well, what I figured was if we change our perspective, our internalization of what it means to take a loss. So rather than think of taking a loss as avoiding bad outcomes, you want to reframe how you think about it to that you are wanting to gain the best small loss. So if we even change these to a nice green, both of them to a nice green. This is quite long-winded, but I think you're getting my point. So I want to gain the smallest loss. So if I'm going to take a loss, that's fine. But if I'm going to take a loss, I want to move towards the small loss rather than the big loss. So I want to gain the small loss. Whereas if it's red, you're thinking, I want to avoid having any loss at all. And so you're not going to do anything. But if you're thinking, okay, this trade isn't looking that good, I want to gain the smallest loss possible, then you'll be like, cool, I'm just going to cut it right here. So that's a way that you can change your omission bias to action bias when it matters the most. This also ties in very closely with towards versus away motivation. And towards motivation versus away motivation is essentially when you are moving towards an outcome versus moving away from an outcome. So let's say you are cold and you have towards motivation because you want to go towards warmth. You want to get warm. That's towards motivation. Whereas away motivation would be, I'm cold, I want to avoid being cold. That's more likely to lead to inaction because of emission bias. Whereas if you are cold and you want to move towards warmth because you want to get warm, you're more likely to take action. So if you can identify the times or areas where you want to take action and then use your language to use towards motivation language, then you're more likely to take action. And that can be used for also just getting things done in general. Like if I want to mark up some charts, I can think that I want to, you can just use towards motivation language rather than away motivation. So rather than saying, I want to avoid missing another day of doing all my markups, you can say, I'm looking forward to actually doing as many markups as I can. Like just by making this simple switch, that could actually make you more likely to naturally take an action versus naturally have a tendency towards inaction. It's just a little concept that I thought was really interesting and thought I'd explain, but this has been a perfectly long video, and that last bit was very long-winded, but I think it's a very valuable point to observe. A lot of gems in this video for myself that I've been learning about over the last week and building my process to make it more rigid. As I just showed with this whole thing up here, like this is taking a long time to come together, but it's slowly, bit by bit, is becoming a lot more structured with how I look at price and how I find trades. And this taking one trade per day and looking for very specific models is another piece of the puzzle I need to add in. And then I also just need to have consistency in my execution. And that might look like consistency would mean stop loss, TP, not doing anything. That would be one way to be consistent. But then obviously, if I know it's going to take me out my stop, why would I do that? So I just need to figure out this area right here so that I'm not ending up with all these errors in my charts. But a lot of steps in the right direction, and I know that I have everything I need, and it's just a matter of putting those last little pieces together that makes what I already have, this whole system, to be consistent. I think I've mentioned before, I do have like a million different models and things, and not all of them I'm actually using, but a fair few of them I am actively looking for, but there are too many of them. So all of these models and frameworks and signatures and everything, a lot of them work perfectly fine, but what I figured is that I'm only going to trade this one framework with this particular account, this Trade of 8 My Fund of Futures account. I'm only going to trade one framework. I'm only going to trade one time a day and just see where that takes me. So because I could find 100 different trades in here, and each of them I would label with a framework, with a bias, with a narrative, and an entry technique. Like every single one of them, I could name it. I could find trades everywhere through here and call it something. But when I try and do that, I just end up over trading, taking a million losses, and even if I'm right, if I was right about the day, I'll end up just getting absolutely destroyed because I'm just trying to focus on everything all at once. So narrowing my focus is definitely a major thing, and I'm really happy with how this week went because, as you can see, there'll be a nice green day here, but only one trade a day, and that's exactly what I need to be doing to do well on this account. So yeah, that'll do for this video.